Okay, welcome to this seminar for September 2019 CAIA exam. What we would like to do today is to give you a feel and a bit more information as to the examinations and how at Kaplan that we conduct our program, the course, to help our students to pass the exam. Okay. Just a little bit background of myself. Yeah, I've been the trainer for the CAIA level 1 for this diet. Well, you can go through this when you have time. Okay, let's spend just a few minutes on the market of AI, right? Alternative investments. I'm not sure whether, is there any one of you are already in the industry? Yes? Doing real estate. Yes. Well, actually, in the previous diet, I also got a few students in the real estate industries, and I met one of them again just in one of the events in the past few days. Well, you know, CAIA arranged all kinds of these events, social gatherings, networking, and also a little bit of market information events for the members and students. Yeah, it's very nice to meet each other during those events. And real estate actually is one of this, I would say it's the highest growth area within the AI, okay? And of course, apart from real estate, we have other areas as well, hedge funds, private equities, commodities, and managed funds. Okay, yeah. Real estate is one of these upcoming areas, but the core of the alternative investments, I mean, the area that most money of the alternative investments are still in, are not yet in the real estate, right? It is mostly in the hedge funds and the private equities. But then again, here we say that alternative investing has gone mainstream. It's not telling people that the alternative investments is the accounts for the largest market share. No, that is not the case. The traditional investments is still the core. If you go to any of these institutional investors, be it pension funds, insurance companies, most of their monies are still with the traditional investments like fixed income, equities. Okay, but then again, gone mainstream here, what we mean is the growth. The growth of the alternative investments, I'm sure it is higher than the growth of the traditional asset classes. Okay, so if you want to focus on the growth of the market, yeah, probably AI is the area that you should look at. And here, just give you a breakdown of all these different components of the AI in the market right now. So as I said, well, here the blue bar, yeah, represents the hedge funds, and this the brownish portion of the bar represents this private equities. These two are still the core of AI. Okay, so they account for I think 80%, nearly 70 to 80% of the AI investments. But what is upcoming is in these regions, right? Including private debt, infrastructures, real estate. Yeah. So these figures are only up to about 2017. So if we have been able to update this chart, I think you should be able to see something different. Yeah. And that is another chart too, just to show you about this institutional investors' allocation into alternative investments. Here it says that for the institutional investors, again, it includes all these pension funds, insurance companies, and banks. For this core AI, private equities, hedge funds, well, maybe a bit real estate as well, around half of the institutional investors have already started their AI investment program. Okay, and some of them, of course, they started years or decades ago. Okay, and some others might be a little bit cautious. They started their investments a little bit later. Yeah, but anyway, by now, over 50%, 50 of the institutional investors have already made their allocation into alternative investments. And for the other types, infrastructures, private debt, commodities, natural resources might be a bit less, around 30 to 40%. So around there might be only one institutional investors out of 3 have already put the money into this area. And again, I'm sure that they will put more. They will put more. Yeah, yeah. Well, because when we look at this, it's a little bit interesting capital market environment now we are in. Very long period of low interest rates, and with a lot of interventions from the government. Yeah. So a lot of these institutional investors are looking for ways to diversify. Okay. So when they look for diversification, they look for new asset classes. Right. Yeah. And on the bottom half of this chart, it's just to show you the current allocations into the AI by these institutional investors are still pretty low. Even for this core AI, like private equities, hedge fund on the top here, the purple bar means that, well, some of these institutional investors, they have put into 20% or more of their portfolio into AI. But it is only a small portion of the institutional investors. And most of the others putting less than 20% of their portfolio into AI. So there is certainly there's some scope for growth. And the scope for growth is even much more than the other types of AI, infrastructure, private debt. Because currently, I think the allocation to the infrastructures, private debt, natural resources, this type of AI is mostly less than 10% of the institutional investors' portfolio. Yeah. So it will grow in the coming years. And in line with the growth of the market, CAIA, I'm coming back to the CAIA, the CAIA membership has also grown at the same pace. Okay. And here this data back to May 2017 says that the membership number of CAIA was up to 9,000. Yeah. And by now, of course, you can guess it is more than 10,000. Okay. And probably it is the second largest investment communities, yeah, or associations globally. Yeah. Well, you know the biggest one. Yeah. And this one is the second largest one. Of course, these two have different focus in terms of their curriculum and also in terms of the membership. And and certainly the CAIA has managed to achieve higher growth in the recent years. Okay, and that is what some of these CAIA members says. Well, I don't want to go through much more details here, but I think the CAIA members have found it quite rewarding, yeah, to be a member of the associations, in terms of the knowledge, the expertise that they can get from the curriculum, and having got the qualifications, how has it helped their career to improve their marketabilities, all this. Yeah, but then I would like to come back to all this networking and event organized by the CAIA, which I think is very helpful for the members. Just to keep track of the market development. Yeah, I've been a CAIA member for years. I'm one of the pioneer members of the CAIA associations in the Hong Kong chapter, and all along I've been attending their events. Yeah, which I found is quite useful. All right. Okay, this is the exam that you're going to take. Yeah. Have any one of you registered already for the exam? No? Still thinking about it? Okay. 2 levels for CAIA. For level 1, 2 sections here. section 1 and 2, both of them last for 120 minutes, 2 hours. Yeah, for each session is 100 questions. And for level 2, there's a little bit of different in terms of the format. Section 1, still 100 questions, multiple choice. And the section 2 is different. It is the constructed response questions. So you have to pick up your pen and write down your answer. Okay. For the other sections, it is run by the computer. Yeah, the way it works is walk into the examination center, then you key in all this your details. Yeah, then they will just generate your papers for you. So the one sitting next to you might answer a different set of questions from yours. Okay, so they have a very big repository of the questions. So all these are drawn randomly to make up a paper for you when you walk into the centers. And all these are run by the computers, multiple choice. But for section 2 on level 2, that is a little bit different. That is constructed response. That is what they call it. And some people call it essay type of questions. But you are not expected to write an essay. Yeah. But you are just expected to pick up your pen to write down your answer. Yeah. Just a different way to test your understanding. And these are the exam topics for level 1. Okay. Professional standards ethics basically is to maintain the integrities of the associations and give the members a bit more recommendations and guidelines how we should go about to do our job. Yeah. What is our duties to the employers, our duties to our clients, and how should we go about to give our recommendations, give our advice to clients, and execute the advice for our clients. Yeah. If there's any conflict of interest, how should we handle all these different issues? So that is what is the first items about professional standards and ethics. Yeah. And the next one, introductions to AI, alternative investments. Yeah, it will give you an overview. Yeah. And then it will give you a bit more tools, a bit more knowledge. Well, it is a general tools for all the investment professionals. Yeah. All the investment professionals are expected to know, to a certain extent, some of this, for example, statistics. Okay. Probabilities. Yeah. All these different kind of return measures, risk measures, probability distributions. Yeah. So for those of you already studied this, yeah, maybe in your first degree or maybe in other exam, it would put you into a little bit of advantage. Yeah, that will cut down your study time. Yeah. For those others who have not touched those areas before, yeah, you might need to spend more time on it. Yeah, because previously, I got some questions from my students. They might come from sales and marketing background. Yeah, they are not very quantitative, and they are a bit afraid of this quantitative content of the curriculum. Yeah, yes, there would be some quantitative stuff in the curriculum that students have to study hard. Yeah, but I can tell you that won't be a big chunk in your examination paper. In general, they say this quantitative type of questions would account for about 1/3 of the paper. Okay, so the others are mainly qualitative stuff. They will ask you to test your understanding. Yeah, whether you know the definitions, the concepts, and how can you apply in different situations. That kind of questions, right? You don't have to always punch your calculator to work on the answer. Okay, and which will only account for about 1/3 of the paper. Okay, after this introduction, we'll go through individual types of AI. Real estate, hedge fund, private equity, structured products, and some risk management and portfolio management. So for this part, yeah, you will cover all these different types of AI, and you will find out what they are. Yeah, what they are. At least you will find out how they are differentiated from the traditional investments. When we talk about traditional investments, we always talk about asset classes. All right? The most popular asset classes, of course, is, as I said, equities, fixed income. Okay? Equities have its own characteristics. Fixed income has its own characteristics. Okay? So they are defined by their own characteristics. But when we look at the AI here, hedge funds, for example, which is the core of the AI. But there are so many different types of hedge funds. They can invest in so many different types of things. So hedge fund itself is not exactly an asset class. Okay? When we are going to cover to learn what these are, we are not just learning the asset classes, we are learning how they run the money. Yeah, learning their strategies. Okay, that is one thing, one aspect which differentiates the alternative investment from the traditional investments. It is not just about what they invest in. It is more about how they invest in. What are their strategies? What are the characteristics of their strategies? Okay, so that is about level 1. Okay, we've gone through this. Heavy quantitative, some of the questions, yeah, you have to prepare. And then it's level 2. Yes, please.
Just a quick question. The NCs, are they going to be as well written on paper, or is this in the computer?
In the computer. It's run in the computer, yeah. Yeah. Okay, coming to level 2. Well, you find these topics similar to level 1, right? Yeah, you will still have to go through these professional standards and ethics. And something new is this current. They have some latest research, latest articles on these hot topics in the markets. So we have to study this as well for level 2. And also, asset allocation and institutional investors. And that differentiator, I think that is the key differentiator of level 2 from level 1. Okay? Yeah, although you go through the rest, you also go through this private equities, real asset, hedge fund, and on, like level 1. But we tackle these topics from a different angle. On level 1, you will learn all these different types of AI, you know what they are, how they are run. Yeah, it's kind of on its own, bottom up. And now coming to level 2, you are going to be just like an orchestra. You put them all together. Yeah, and then you consider under what scenario, what type of AI, what type of hedge fund, or what type of private equities would be most suitable for my clients. So in a way, is how do you make use of the alternative investments to help clients achieve their goals? It might be on top of their existing traditional investment portfolios. Yeah, how can I blend this AI with the traditional investments to come up with a portfolio which is suitable for my client? Yeah, so that differentiates level 2 topics from level 1. All right. Okay. Okay. Level 1, okay, just a recap here. Understand the general nature of the AI, and level 2, in-depth coverage. Yeah, and probably on top of that, I will also add on. From level 1, you learn the topics from a bottom-up perspective. And for level 2, probably you do it the other way around. It's a top-down. Okay, how can you apply different AI into a portfolio to adjust different risk exposure so that your clients can achieve their objectives? Okay, these are for your informations, exam fees and the dates. Okay, early bird passed already. And now you have to pay the standard fee, right? Early bird up to 13th of May. Okay, standard fees 1250, $1,250. Okay. Well, it is much cheaper than the postgraduate courses.
The exams only in September, or are you having them as well in the spring?
September and March.
So the same is going to happen again in March?
Yes, and that is a good question here. Yes, there are 2 dies every year. Yeah, for the examinations. Okay. Okay, anyway. Well, here in front of you are those materials that we use, yeah, for the class, right? These are the notes prepared by Swipser. Okay, Swipser just based on the curriculum, they write up these materials to help students to study efficiently. But those materials, curriculum from CAIA, yeah, of course they are they're much more in terms of volume. Yeah, and also the key thing to note is the current curriculum is running on the 3rd editions of the CAIA materials, or the CAIA book. Okay, it's the 3rd editions, and every few years they will update or revise, yeah, their materials. Yeah, so they revise, update, they change the curriculum a little bit, and they revise their materials. And the 4th editions is coming up. If you are going to take the exam, the level 1, anyone here are going to take a level 2? Okay, level 1. For those of you are going to take the level 1, September this year, okay, you are still studying the 3rd edition. And, well, hopefully it is not relevant to you, but for those who are going to take the exam, level 1, in March next year, you might be required to study the 4th editions. Yeah, it depends on how quick they can turn it out. Yeah.
How many hours of studying is recommended for each level?
Minimum. Oh, I have to be careful on this. Everybody's are different. Okay. Yeah, just for general reference. Okay. A minimum 200 hours. Yeah. Okay, passing mark. A little bit some volatilities lately. Yeah, roughly around 50% usually. Yeah.
What happened here? Well, since September, how does it compare with the March 19th?
Nobody knows.
Have the exams got harder?
No, shouldn't be. Yeah, yeah. But sometimes it's not about the exam. It's about, well, the quality of the candidates.
This is global, right?
Yes.
Global.
It's global. Yeah, yeah, yeah. Okay. But anyway, yeah. And some people try, failed, and well, probably they should come back again. I think just to find out why did you fail. Yeah, I think this is a very important question for those come back to retake the exam. Okay, yeah. But of course, everybody got different reasons. Yeah, and one of the most popular reasons is lack of preparations, number of hours of study. Yeah. Yeah, especially when you have a family to take care of. So if you are still singles, you are again at an advantage. Yeah. All right. Okay. Any questions so far?
So you would recommend, well not recommend, you in your opinion you would say 200 hours minimum of study. So would that be spread across, let's say, what sort of time frame would you suggest?
If you ask me, I would say 200 hours are not sufficient.
Okay.
Yeah. But, well, of course, people, they might still pass the exam. Yeah. They might still pass the exam. Yeah. You don't have to be getting the full mark. Right?
That's a passing rate then.
That's a passing rate. Yeah. Yeah. And it also depends on how much hours that you can afford to sit down, focus on the study.
Yeah.
Yeah. Sometimes you sit down for the first maybe half an hour, you still,
That's what I'm getting at.
yeah, you still, you still think about some other thing else, right? And usually people start their study about 3 months beforehand. Beforehand, yeah.
The thing is, with everyone's daily lives, there's always distractions,
Yes.
other interferences.
Yeah, that's right, that's right. Yeah. Some people can get up 6 o'clock in the morning. Yeah, so they can study at least maybe 1.5 hours before they go to work. But not everybody can do that. Yeah, and quite a lot of people actually they do it at night. But then again, if you have a family, and the worst thing is that you have kids and you have to wait until your kids go to bed, and by that time you'll be about 10 o'clock, 11 o'clock, and not much time left. Yeah, so it depends on your own situation. When should you start your study?
Let's say if you want to pace yourself at a decent rate, and covering all the material, would you say what, maybe 6 months is enough? Try to be
And also depends on your background. Background.
non-finance background.
Non-finance background. 6 months could be good, yeah, so that you allow yourself sufficient time to do it. So we are now at the end of May, so we only have June, July, August, 3.5 months. 3.5 months is still doable, and it comes back to how much time that you can allow yourself to prepare for the exam. Yeah. Yeah. So I think, well, 3.5 months actually it is quite reasonable time to start. Yeah. Yeah. Of course, if you can have 5-6 months, it's better. Yeah. And I can tell you now that based on my experience, most of the stuff in the curriculum, when you go through it, okay, you can understand. Okay, no problem. All right, maybe a little bit technicalities that you have to think about. Yeah, but still you can grasp it. You can grasp the concept. But the problem is, just like most of this professional exam, going through once understand is not sufficient. After a month, after maybe 1 or 2 months, and you come back in the final 2 weeks before the exam, well, you find out that actually you forgot most of the things. That is very, very common. The retention rate for most people, yeah, usually is very low. Yeah, yeah. And that's why don't think that you go through this once, then you'll be,
You're referring to memory, right?
yeah, memory and also the volume of the curriculum. Yeah, the volume of the curriculum, and that makes you have to go through this, well, at least twice, I think. Yeah.
Can you talk a little bit about the hurdle rates to pass, like passing rates, 2/3, 4/4?
Well, there's no details released as to this minimum passing rate or grade or mark. No, there's no such things. Yeah, but well, I believe there's some kind of methodologies. Yeah, to work out what is the percentage of failure. Yeah, but I'm not sure whether there's a minimum passing rate.
And you may not know if this has been changed in regard of this passing rate that you just showed before, right? Has this been adjusted? Because now you have like 5 years track record twice a year, and then suddenly this is going to drop sharply. There may have been change, right? I think it's not the sample. So has there been any change in the exam itself?
But we cannot draw any conclusion just based on one result. On that.
Well, these are 2 exams. This is level 1 and level 2.
Okay, in the same point of time.
Right, there's 2 different groups, right? anyone is taking level 1 and level 2 within 1 week.
Okay, but as far as we are aware, no changes in the way that they mark their papers.
So what's the official response why we have seen a 50% drop or a third drop?
I have no clue, but honestly, I have no clue. Yeah, but I don't want to guess either.
It's okay.
Yeah.
Remarkable, right?
Well, it happens before. If you look at for example, if you look at the CFA passing rate, yeah, might be once every few years there might be a little bit of ups and downs. Yeah. Okay. Let me spend the rest of this sessions just to go through a little bit of the materials that we'll use in the class. Yeah, to to go through the curriculum. Here, measures of the risk and performance is part of the introductions to alternative investments. Okay, may I just go back a little bit here? Level 1, okay. So around all these topics, all right, I pick out a few slides out of our education programs on these topics, introductions to alternative investments. All right, but I'm not going to talk about this hedge funds, private equities. What I'm trying to do here, just to give you a flavor, yeah, when we come to the quantitative part, yeah, some people might think it is very hard, but I just want to let you know it might not be as hard as people say. Yeah, they are not going to ask you to do a lot of calculations, very technical mathematics. No. Yeah, but then again, we have to understand the concept behind the equations, the formula. For this topics is about VAR. Okay, so it is not just for alternative investments, right? It is for all types of investments. Actually, this concept, value at risk, VAR, applies in most aspects of the financial community now, right? If you go to the banks, insurance companies, or even corporates, right? They use these measures, yeah, to gauge the risk that they have engaged in. Okay, so this is a kind of the requirements under these topics. Apply certain approach to estimate the VAR. So that means we have to do some calculations. Before we do the calculation, we have to understand what it is. And apart from this approach, there could be different types of approaches, yeah, to work out these figures. So in other way is one concept, more than one approach. Okay, so we have to understand the concept, and we know how to work it out with different approaches. Of course, some approach is better than the others under certain circumstances. Then we have to understand what circumstances under which approach should we use. Okay, so that is the advantage, disadvantage of this individual approach. Okay, so well, basically what we are talking about is if that is the mean, the average, right? The average could be your portfolio value, or might be the average of your portfolio returns. This average is just an average of many observations. Okay. Of course, there will be dispersions. Sometimes you do better than expected. Sometimes you do worse than expected. Okay. Now, when we come to this VAR, value at risk concept, we look at the scenarios that you might do worse than expected. When you do worse than expected, we go to the left-hand side. Okay. So VAR is just to give the people some ideas. If things don't work out, yeah, what could be your loss? Okay. And this VAR has a very good point, and that's why most people use it as it can apply in different industries. It is the loss over a specified period with a specified probabilities. Okay, you can tell people in a day what you think you might lose with what probabilities, right? 1 day, 1 week, 1 month, or 1 year. So that even people don't know how you manage your portfolio, might be they have a good sense as to what is the downside. Okay.
Is this graph showing the amount of risk that you're taking on, or the amount of the returns compared to risk?
It is a graph to show the dispersion of the returns. Okay. Yeah, for example, let's say returns. Yeah, but not necessarily returns. We can talk about value. Okay, value is in dollar terms. Returns is in percentage terms. Okay, so in good times, well, we go this way. We earn more money, right? In bad times, we go this way. We lost money. Let's, for example, if you are expected to make 5%, right, per year, yeah, then I can tell using VAR might be I might lose 10% in 1 year. Yeah. Then people might ask, what is this minus 10%? Yeah. Do you always lose 10%? No. It's not always losing 10%. I have to look at this. Well, that is the probability distributions. And I would say, for example, if it is with the specified probability, I have to tell people what is the probabilities. I might say it is a 95% confidence. With 95% confidence in a year, on average I make 5%, but yeah, at the maximum I might lose 10%. Yeah, that makes people have a better idea to judge the risk that they are taking based on the dispersion of the returns. Okay, and in other words, some people might turn it around. Okay, just a different language, right? People will say with 5% significance, the portfolio will lose at least 10% in a year. So it depends on which way you look at it. Okay, and sometimes the question will come out a little bit tricky language to trick you. Yeah, do you really understand this VAR concept? Yeah. And apart from this approach, this is what they call is a parametric approach, and we have different approach: historical approach, Monte Carlo approach. That we'll go through in the class. And this, going back to the parametric approach, this is the equations. Okay, yeah. And the questions in the exam might ask you to calculate, to estimate the VAR, or might be the exam questions might ask you to work on something else, like this VAR is based on these volatilities of the returns. Okay, and this volatility of returns can be measured with different time horizon. It could be a daily volatilities, monthly volatilities, and on and on and on. So they just change these parameters to confuse you a little bit. Yeah, and make sure that you understand what it is. Oh, this is another example. In the class that we'll work on some examples to make sure that we understand the concept and also can do the calculations. And also, yeah, once that you understand the concept, we drill down a little bit deeper. Yeah, within the portfolio, of course, we invest in more than one thing, more than one asset. Yeah, when we invest in more than one asset, how do we look at this risk of the portfolio? Everybody here, I'm sure you notice about this diversification benefit of the portfolio, right? If you invest in two different investments, which are not perfectly correlated, there will be diversification benefit. And how do we translate this diversification benefits into the aggregate VaR of the portfolio? Yeah, then we have to know a little bit of this relationship. And then we might do some this classroom questions. Yeah, it's also like what you might come across in the exam, multiple choice, A, B, C, or D. Yeah.
Is that just one part of the exam?
Is it?
For the VaR, is it just one part of the exam?
Yes. It's. May I just go back again? VaR is a small part of the exam. Yeah. Well, we said that within for the level 1 exam, right? There are all these different topics. Okay. Within different topics, they have a lot of these learning objectives. And within, just for example, within this topic, introductions to alternative investments, I think there are around 9 different sections, 8 or 9 different sections. And one of the sections is related to this risk measures. Okay. And within these topics, okay, you see it is 5.2. Of course, you can imagine there are 5.1, 5.3, and 5.4. So VaR is a small part of it.
Okay, so the VaR, what's the percentage, the lowest possible percentage on the exam related to VaR?
Percentage?
On the exam, let's say it's 5%.
Oh, it will be given in the questions when you do the calculations.
What's the percentage on the actual exam? Because there's different parts, right? There's like alternative.
There's no specified percentage on each topics. There's no, yeah.
So I'm just wondering, every different topics is like different pockets, right?
Yes.
Like alternative investment.
Yes.
So all that's part of the MFR within that section, or is it just one little section?
It's a separate sections under this topic 2 related to introductions to alternative investments. Okay.
There's not a lot.
Yeah, not a lot, small part. Yeah. Okay. Yes, there are different approaches under this concept, and yeah. So we'll go through this concept calculation and do some exercise during the class. And maybe to give you a bit more flavor, is another one. It is also under this topic 2, introductions to alternative investments, related to options. Okay? Options is mostly related to structured products. Okay? Within the CAIA examination curriculum, structured product is also a type of AI. It changed the payoff of the investments. And most of the time, they make use of derivatives like options. Okay, so they put this option part into topic 2. It's part of the introductions to alternative investments. Okay, and again, you can see that within this 6.6, there's quite a lot of these different learning objectives. Right? Learn the characteristics of different types of option positions. Long, short, call, put, spread, and also further discuss how do we mix this up to come up with a structured products. Okay, we are not going to be a structured product specialist. Okay, but we have to understand how people mix these things up to come up with a product. Only when we understand how they mix things up to come up with this product, we can analyze where the return come from and where's the sources of the risk. Okay, if we don't know how they construct it, we cannot analyze. Okay. So in order to understand how they construct it, we go to the basics first. And here, a long call. Well, as you might know that, if you buy a call option. We call it a long call option. A call options give you a right. When you exercise the right, you can buy the underlying investments at a predetermined price. Okay? So this predetermined price is strike price. When the underlying, let's say, is a stock, when the stock price, that is the stock price, the x-axis goes up. Of course, the stock price goes up. If I have a call, I can purchase the stock at the strike. The strike is lower than the current spot price. I make a profit. I make a profit. The further the stock price goes up, the more profit that I can make. Okay, that is the payoff from the call options. So we know, okay, long call, I have a call options represented by the red line here. But if the stock price doesn't move, I have to pay this premium. I buy something, I have to pay for it. And they call it is an option premium. Okay, I pay for it. If the options expire worthless, okay, I don't exercise it because the stock price does not move, I lost the premium. Okay, so similarly, we have short call. I don't buy the call option, now I sell to you. And this time, my profit comes from the premium. I receive the premium from you. But then again, if the stock price goes up, the further it goes up, the more I will lose out. Okay? That is the short call. I sell the call. And then, other type of option is the put. When you buy a put options, you have the right to sell. This time is to sell the underlying, to your counterparty at the strike price, at a specified time. So for that, if the stock price goes down, the further it goes down, the more profit I can make, because I can sell the underlying to the counterparty at the strike price, and the strike price is higher than the current spot price. Therefore, I make profit. Okay, if I want to protect my portfolio, I buy a put, I long put. Short put is the other way around. Okay, short put, what I earn is the premium. If the stock price goes down, I have to pay you off. Okay, I lose money. Okay, that is the other way around. So based on these very, very simple things, call, put, long, short, we can do a lot of things. Right? We can do a lot of things here. Here I combine underlying positions with a call. I short a call. It's a cover call. Here I combine the underlying, I long a put. That is what they call is the protective put. When I have a protective put, well, my net positions will be like this. Yes. If the stock price goes up, I will benefit, but less. I will benefit less than the original position because I have to pay for the put. Just in case the stock price does not go up, if the stock price comes down, my downside will be limited here. Probably that is the strike. Anyway. So, it depends on what you want. Do you want to protect your downside? Do you want to expand your upside? How much do you want to expand your upside? Or sometimes you want to just, what do we call it is a collar here, or might be a spread. You want to put your payoff within a range. Yeah, you see, might be the underlying stock, might go up, might come down, but most of the time will be trading in a range. Then you can think about this. A bull spread or might be a bear spread. It's made of one of those things that we just mentioned. Long, short, call, put. But we use different strike prices here. Yeah. For example, a bull spread, we long the call at low strike. We short the call at high strike. Okay, usually we short the call at high strike, the premium will be lower to subsidize the premium that we have to pay for the low strike call. Yeah, in a way we lock our payoff within that range. So that is a very common tools used for structured products. Okay, and again, it is only part of the curriculum, and I just want to show to you. Sometimes the curriculum can come down to something very quantitative, a bit tactical. Yeah, if I go further, oh, that is the most. If I go further on this option strategies, yeah, or might be if you are familiar with the structured products in the market, yeah, there will be a wide variety of structured products available. Yeah, and for every single one of these, you can analyze them just using this simple basic building blocks. Okay. And also, this is the type of the questions that we might go through in the class, again, to test your understanding. Yeah. Just looking at these long, short positions, call, put, underlying, no, sorry, call, put options. Yeah. You might have no problems to understand all this. Yeah. But when we really apply this in different scenarios, yeah, you have to do some exercise to make sure that you're familiar with, yeah, how it can be applied in the situations. Yeah. And here might be for hedgings that if you have a debt or bond, yeah, of a commodity producers, yeah, it could be an energy company bonds in your portfolio, and you are afraid, you fear that the company might go into default. How can you make use of these options or futures to protect your downside of the bonds? So that is the applications of the options or the derivatives, yeah, in that situations. Yeah. So for these topics, we will do this class exercise. For other topics, we will similarly, yeah, do other class exercise, yeah, to make sure that concept, understanding, and also calculations, yeah, you can handle.
Is the answer C?
Buy, put options. Bingo. Yes. Okay, interesting.
Yeah, I was wondering whether A or C.
Yeah. Why not D?
Maybe the futures are not tied with the producer debt.
This is direct by the asset.
D is not the right answer because when you sell the futures,
You can't sell futures, can you?
yes, you can sell futures. You can sell futures, right? When you sell futures, okay, you protect your downside. You also give up your upside. Okay. Okay, but, well, that is the exercise that we'll do in the classrooms. All right? Any questions? If no, I pass it to my colleague, and she will give you more details, yeah, as to our courses. Yeah.